Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered.
Thank you for tuning in to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I'm your host, Virginia Lucci, coming at you live from my house in Montgomery, Alabama, nestled in the heart of Central Alabama. I'm excited about today's show. As always, I'm starting out with the word on the street. I want to check out our economic policy and see how that looks in real life, but stick around for the second half of the show where we talk about Berkshire Hathaway and the Oracle of Omaha, Warren Buffett. This episode's top 10 will give you a little bit of Buffett's insight with the top 10 stocks Berkshire is getting rid of following the second quarter. I want to start off with my normal disclaimer. I'm not providing legal or financial advice. This show is for entertainment purposes only, so don't come at me. The economy is changing by the second. And as always, if you have any questions, visit an attorney or a financial professional for advice tailored to your needs. Now let's get to it. Starting off the week, stocks were mixed Monday following Wall Street's third straight week of gains as investors seek fresh catalysts to continue pushing equities higher. A stalemate in Congress on the next round of coronavirus stimulus, U.S. and China trade tensions, and the end of summer vacation season were leading to cautious trading and light volumes. The Dow Jones Industrial Average fell 84 points, or 0.3%, to 27,846. The S&P 500 gained 0.25%, and the NASDAQ was up 0.84%, led by gains in Tesla, NVIDIA, and JD.com. So, for a little context, let's look at what happened last week on the street. The Dow rose 1.8% last week, and the S&P 500 gained 0.6%. The S&P 500 flirted much of last week with reaching an all-time high, but fell shy and remains within 0.4% of its record. We're so close to making up those gains that we lost during the first shutdown. The tech-heavy NASDAQ rose 0.1% last week, which is not surprising at all. The friction between the U.S. and China, the world's two largest economies, postponed a weekend meeting to discuss the progress of their Phase 1 trade agreement, and that continues to weigh on the minds of investors, as do the stalled coronavirus aid negotiations. In U.S., retail sales increased 1.2% in July, and we're up 1.9% excluding autos, which are just going crazy right now. The former figure is a little weaker than expected, but the latter is a bit stronger than the forecast. So again, we're getting a mixed message. Industrial production rose 3% in July, and capacity utilization rose to 70.6%. Business inventories dropped 1.1% in June, marking a sixth straight decline, while business sales climbed another 8.4% in June. The University of Michigan Consumer Sentiment Survey inched up 0.3 ticks to 72.8% in the preliminary August reading, following a 72.5 reading in July. Second quarter non-farm productivity was reported to have grown at a 7.3% rate, bouncing from the 0.3% contraction estimated for the first quarter. The large cap S&P index has started the month of August on a strong note, with 7 of 10 trading sessions on the upside. Historically, this early month strength has been followed by further upside through month end. This was according to Mark Chaikin, founder of Chaikin Analytics, a Philadelphia-based quantitative investment research firm. He further stated that this is consistent with our view that we are expecting a Fed-driven gradual melt up in stock prices. 2 of Wall Street's bears on Tesla have softened their stances as analysts at both Bank of America and Morgan Stanley have raised their ratings on the stock to the equivalent of a hold. Morgan Stanley's Adam Jonas upgraded Tesla to equal weight from underweight with a price target of $1,360, up from $1,050, as he is now assuming the benefits of a transfer of supply of batteries and EV powertrains to third-party car makers as part of his base case scenario. Meanwhile, Bank of America analyst John Murphy upgraded Tesla to neutral from underperform with a price target of $1,750, up from $800, as he argues the company's unfettered access to low-cost capital remains a key advantage that should be leveraged to accelerate growth. Among the noteworthy gainers was Mesoblast, which jumped 51% after the company announced that the Oncologic Drugs Advisory Committee of the U.S. FDA voted 9-1 in favor that the available data support the efficacy of Remistrimcel L. I think I'm saying that right, but I'm not sure. In pediatric patients with steroid refractory acute graft versus host disease, which sounds just like a great way to go. Also higher was McKesson, which gained 4% after the U.S. Department of Health and Human Services and Department of Defense announced that the company will be a central distributor of future COVID-19 vaccines in support of Operation Warp Speed. Among the notable losers was Paysigns, which dropped 22% after the company reported second quarter results last week. Also lower was GSX Tech EDU, which fell 11%. The company, like IQIYI, is domiciled in China, trades in the U.S., and has been accused of fraud by short-selling research firms. So that's something to keep an eye out for. What I'm really looking forward to this week, retail earnings are going to be released. Let's take a look at 2 of the biggest names that we're waiting for, Target and Walmart. They are the 2 old stalwarts battling against the likes of Amazon for supremacy. Both retailers were early beneficiaries of the shutdown because they didn't have to shut down. Their recent investments in online efforts were also viewed as advantages because they allowed companies to ship direct or let customers come in for curbside pickup. And I am a huge fan of the curbside pickup. Nevertheless, because of the situation we're in, the past 3 months have been mediocre. Target stock has gained just 13% during the period, while Walmart stock is up just 7.3%. Those gains lag the SPDR S&P Retail Exchange Traded Fund, XRT, which is up 42%, as well as the S&P 500, which has risen 18%. The ETF got a big boost from online retailers like Wayfair and Etsy, up 81% and 51% respectively during the past 3 months, and from struggling retailers like L Brands, which is up 153%, and the discounter Big Lots, which rose 86%. So does that mean big box is out of style? Walmart and Target can't blame it on poor retail sales. July sales rose a solid 1.2% from a month ago, but more surprisingly are now 1.7% higher than they were back in February before the virus hit. The numbers are particularly impressive considering that COVID hit parts of the Sun Belt especially hard last month, and that fiscal support from Washington has slowly been running out, according to economist Anita Markowasa from Jefferies. And I still can't say that name right. There was already tremendous momentum for consumption at the end of the second quarter, and July sales will reinforce that momentum, she continues. Walmart and Target now get to show that they have benefited from the strength, and some investors are betting that Target will do a better job of it than Walmart. It's not that Walmart's doing anything wrong per se. Cowen analyst Oliver Chen, for instance, calls the stock one of his best long-term ideas. But Chen isn't really excited about the prospects heading into earnings. For starters, Walmart isn't cheap. Even after underperforming recently, its stock looks expensive at 25.1 times 12 months earning forecast, up from 22 times at the beginning of the year and at 24 times Cowen's estimate. Last week, Instacart and Walmart announced they are piloting a partnership in 4 cities across California and Oklahoma. They also announced a partnership with Shopify, big difference there, to allow more third-party sellers to have access to their marketplace. Maybe a same-day grocery will be the benefit of its upcoming Walmart Plus membership service. But Chen is concerned because the service has been delayed and is really causing investors some heartburn. Recent media articles indicating a delay and likely smaller rollout, along with key vague management commentary, could pressure shares which are trading near record highs, Chen writes. Shares of Walmart are currently priced for perfection as we see a challenging setup into earnings. Walmart is expected to report a profit of $1.24 a share, according to FactSet, down a touch from the $1.27 during the same period a year ago. Chen likes the setup for Target a little bit better. He argues that the chain will be able to top same-store sales estimates as shoppers buy more clothes and continue to shop for food. He estimates that comps will come in at 5.5% above the street's estimate for 5.8%. Its shares also look cheaper than Walmart's based on Chen's own estimate of 19.5 times forward earnings versus Target's 24 times. Target trades at 22.1 times consensus estimates. We view Target's valuation as more favorable, he writes. In my opinion, Walmart Plus is kind of a game changer. The less contact I have with other shoppers right now, the better. And I think I'm going to be feeling this way for a while. So don't sleep on Walmart stock because I think it's still beneficial. Home Depot is also expected to report this week and report an adjusted net income of $4 billion or $3.64 a share on sales of $34.3 billion before the market opens on Tuesday, based on FactSet's survey of 28 analysts. In the same period a year ago, the company posted earnings of $3.17 a share on sales of $30.8 billion. It reported a net income of $2.5 billion. So the stock has risen 18.3% since the company last reported earnings in May of 2019. In the upcoming quarter, analysts are forecasting adjusted net income of $2.9 billion or $2.64 a share on sales of $28.7 billion. For the year, analysts project revenue of $108.2 billion. And, I will say this, that during the pandemic, a lot of people have taken up gardening or some other home improvement project. So personally on the street, I see the parking lot of my local Home Depot is a lot busier than it was a year ago. So I really think these numbers track. Home Depot's biggest competitor, Lowe's, is also reporting this week. They're expected to report adjusted net income of $2.2 billion or $2.87 a share on sales of $24.1 billion, and they report before the market opens on Wednesday. In the same period a year ago, the company posted earnings of $2.15 a share on sales of $21 billion. It reported a net income of $1 billion. Again, people are taking up some hobbies and finally getting to that project that's been in the attic or in their garage for years. The stock has risen 33.1% since this company last reported its earnings on May of 2020. In the upcoming quarter, analysts are forecasting adjusted net income of $1.2 billion or $1.54 a share on sales of $18.4 billion. For the year, analysts project revenue of $78.8 billion. Meanwhile, across other retail earnings this week, Wall Street analysts and market participants will also be monitoring results and commentary around companies' inventory levels, with businesses having closures in the spring having contributed to a glut of unsold items in many stores. This has pushed retailers to sell items with markdowns to incentivize shoppers to purchase excess items, in turn cutting into profitability. Allegedly. I haven't really seen this in real life, so we're just going to look at this theoretically. Ross Stores executive had said in May they expected the majority of markdown activity to take place during the fiscal second quarter. Retail, in my opinion, is a much better analyst of the overall health of the economy rather than the stock market alone. It shows where and how consumers are spending, back to school trends, and to a certain extent, tech gadgets. So tune into my next episode to see how things shake out with brick and mortar. And with that, I'm going to take a quick commercial break. When we come back, we're going to talk about the U.S. economic policy. And if you stay to the end of the show, we're going to talk about Berkshire Hathaway and 10 stocks that they're getting rid of this quarter. So please stick around.
Are you a business owner? Someone interested in the latest news that might affect your business? Then check out the GSMC Business News Podcast, a show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. The GSMC Business News Podcast has you covered.
Welcome back to the GSMC Financial News Podcast. In our last segment, we talked about what the word on the street is for the week of August 17th. And in this segment, I'd like to take a little bit of time to go back and really study what the U.S. economic policy is and what's going on Capitol Hill instead of Wall Street. So first thing I want to look at is what's our trade policy. We are looking at the U.S.-China relations. On Friday, Reuters reported that a review of Phase 1 trade deal between the U.S. and China that was initially slated for Saturday was delayed due to scheduling issues. No new date has been agreed upon yet for the talks. The report added, the officials were expected to hold a video conference on Saturday, the 6-month anniversary of the trade deal's February 15th entry into the force, as right before the coronavirus pandemic really began spreading globally. One source familiar with the talks said the delay was related to a conference of senior Communist Party leaders at a seaside town of Baidaihe on China's northeast coast. And my apologies if I mispronounce that. I'm probably mispronouncing that, but the postponement did not reflect any substantive problem with the trade deal, the source said, adding the new date has not yet been finalized. U.S. President Donald Trump on Friday repeated his view that the trade deal was going very well, but did not comment on the delayed meeting. White House referred queries to talks to Alzheimer's office, which did not respond to the Reuters inquiry about plans for the review. Yet another source familiar with the plan said that U.S. officials wanted more time to allow China to increase purchases of U.S. goods as agreed upon in the deal. This would improve the political optics of the review. China's imports of U.S. farm manufactured goods, energy, and services are really far behind the pace that's needed to meet a first-year target increase of $77 billion more than what they purchased back in 2017. But as China's economy has recovered from coronavirus lockdowns earlier this year, purchases have increased. So that's positive. On Friday, the U.S. Department of Agriculture reported the sale of 126,000 tons of soybeans to China, marking the 8th consecutive weekday with large sales to Chinese buyers. U.S. oil traders, shipbrokers, and Chinese importers also told Reuters that Chinese state-owned oil firms have tentatively booked tankers to carry at least 20 million barrels of U.S. crude oil for August and September, indicating a ramp-up in energy purchases. Trump administration officials have signaled that they are satisfied with the pace of the purchases in recent weeks and have no plans to abandon the trade deal, which also includes some increased access for U.S. financial services firms in China, strengthened intellectual property protections, and removal of some agricultural trade barriers. Delaying the meeting, even briefly, could allow China to complete more purchases, which would help Lightyear persuade Trump to stick to the deal. So it's probably in everybody's best interest to delay the deal. Another issue that's been hot on Capitol Hill is drug pricing. President Trump shared via Twitter that drug companies, which are being forced by me to substantially reduce drug prices, are taking millions of dollars in ads saying, "I want to increase Medicare premiums." Wrong, just the opposite. These ads show drug prices are going down and they are not happy. False advertising. Large cap drug makers include AstraZeneca, Bristol Myers, Eli Lilly, GlaxoSmithKline, Johnson & Johnson, Merck, Novartis, Pfizer, Roche, and Sanofi. This comes just after President Donald Trump just issued several executive orders designated to reduce drug prices. The most consequential of which is dubbed a most favored nation policy. It pegs Medicare payments for medicines to the price paid by foreign governments. This plan probably would actually end up reducing access to today's innovative medicines and stifle medical progress. There are probably better ideas for reducing prescription drug prices. So there's been a lot of speculation that this is not really the best idea because many foreign nations have single-payer health systems that will put a really strict price on the new medicines and refuse to cover expensive drugs or experimental drugs. Patients living in those nations end up with fewer treatment options. Patients in UK and France had access to just 7 out of 10 new cancer therapies between 2011 and 2018, while American patients could access virtually all of them. Because the U.S. market operates differently, insurers compete for patients, usually by offering generous drug coverage. Drug researchers are incentivized to develop new treatments, as they know American patients value the innovation. As a result, research companies across the world generally launch their newest drugs here first. This proposed executive order would slow medical progress. There are currently 4,500 drugs in America's development pipeline. These medications target everything from cancer and HIV to heart disease and asthma. price controls would inevitably reduce drug firms' revenues and leave them less to invest in research and development. This could block the next generation of drugs from ever even hitting the pharmacy shelves. Medical breakthroughs are constantly making it easier and cheaper for patients to stay healthy. A recent study from the organization Partnership to Fight Chronic Disease found that new medicines could avoid $6 trillion in healthcare costs and prevent 16 million deaths by 2030. So we have a really difficult situation because drug prices continue to increase. If you listen to my last podcast, I think it was my last podcast, we did a segment on Pharma Bro who unilaterally raised drug prices to such an extent that a lot of people couldn't afford their drugs. So I really think that there needs to be more regulation on that, but at the same time, we don't want to stifle the creativity in developing better treatments, better drugs, and making it possible for more Americans to live longer, healthier lives. So, is this the answer? I don't think so, but I think that there needs to be a better answer than what our current situation is. So, with that being said, I want to pivot a little bit to the tech firms and what they're really doing to reduce misinformation. Facebook, Google, and Twitter have held talks with federal officials on how the social media platforms can prevent the spread of misinformation leading up to and after the election. Dustin Bowles and Emily Glazer of the Wall Street Journal reported that discussions came as the U.S. intelligence community warned of foreign interference and Trump questioned the vote's integrity. The FBI, Department of Homeland Security, and intelligence agencies were all reportedly involved in the talks, with COVID-19 expected to result in a large increase of people voting by mail. The federal officials and companies are concerned that any delay or problems with mail-in voting could enable circulation of fake stories about how the votes are being tallied. So let's move on from this to what's going on with the Postal Service. So right now the Postal Service is under fire. They are delaying service. I'm sure you've all experienced this. Mailboxes are being shut, and sorting facilities are losing their hardware. Now, the administration has promised not to do any additional closures until after the election, but the Postmaster General is really under a lot of heat. Postmaster General Louis DeJoy is also under fire over a new CNN report that shows he holds stock options in Amazon, which is a conflict of interest. Federal law prohibits employees of executive branch offices from holding a financial interest in a company that could have an impact on their government duties. Amazon is a significant partner with the USPS and has their deliveries completed by the Postal Service on a routine basis. I know that in my neighborhood, we get final delivery of my Amazon purchases, which there have probably been too many of since the virus began. But we always get final delivery through the U.S. Postal Service. I assume that that would be even more if we lived in an urban area, a rural area instead of suburban area. So Amazon and the post office kind of work hand in hand. And Amazon uses the post office for about 40% of its shipping. DeJoy held between $100,000 and $250,000 worth of stock in Amazon when he joined the Trump administration, according to CNN. DeJoy divested his shares on June 24th, But on the same day, he bought between 50,000 and 100,000 of Amazon stock options, which give him the right to buy shares in Amazon at $1,860 per share, according to CNN. As a result, he still stands to benefit financially if Amazon's share price increases. Amazon stock closed on Thursday at $3,161 per share. Democrats in Congress say DeJoy's changes have made mail delivery slower and less reliable. Senator Elizabeth Warren, a Democrat from Massachusetts, tweeted that DeJoy's purchase of stock options in Amazon after his appointment as Postmaster General was inexcusable and said the Office of Inspector General must investigate this corruption. Democrats have also raised concerns that DeJoy retain a significant stake in his former company, XPO Logistics, which is a contractor for the Postal Service. In an email statement to The Verge, Warren wrote that DeJoy has a personal stake in the Post Office Service's decline, and his stake got bigger when he bought Amazon stock after his appointment. House Speaker Nancy Pelosi said Sunday that she's calling the House back into session this week to vote on a bill prohibiting the U.S. Postal Service from implementing any changes to operations or level of service. This action comes amid growing concerns that the Trump White House is really trying to undermine the agency during the pandemic while states expand mail-in voting options. So hopefully we'll find out a little bit more through this. Hopefully the House will be able to reconvene and we'll be able to find a little bit more. Before we end the segment, I wanted to give you a brief update on a story I covered a couple episodes ago. Kodak. White House trade advisor Peter Navarro on Monday blasted executives at Eastman Kodak for their handling of a government loan to produce pharmaceutical agreements in the United States. Now, I'm going to quote him. This is verbatim what he said. Based on what I'm seeing, what happened at Kodak was probably the dumbest decisions made by executive in corporate history. He continued to say, quote, "You can't fix stupid. Based on what I'm seeing, what happened at Kodak was probably the absolute dumbest decision. You can't even anticipate that degree of stupidity." Wow. The $765 million government loan to Kodak has since been put on pause as the Securities and Exchange Commission investigates the company's disclosure of the deal, which was officially announced on July 28th. Shares of Kodak, known for producing film, skyrocketed on the news of pharmaceutical loan. The stock had been languishing for around $2 per share for months. It traded as high as $60 per share on the day after the deal. It was observed that trading activity of Kodak stock picked up significantly the day prior to the official announcement. Questions have also been raised about the timing of stock options granted to Kodak's executive chairman, Jim Continenza. Navarro on CSNBC stressed the investigation of potential wrongdoing by Kodak. "We don't know why that happened or what they did. Let the investigation happen. Kodak's doing an internal one as well, but we're moving forward. We're not looking in the rearview mirror." Kodak shares were down nearly 5% on Monday morning, trading around $8 a piece. So that's kind of interesting information. At this time, I want to take another commercial break. And when we come back, we'll have our second half of the show. I'll focus on Berkshire Hathaway and the Oracle of Omaha. Warren Buffett will give you his top 10 stocks to dump. So if you'll stay tuned, I think you'll appreciate it.
Tired of searching the vast jungle of podcasts? Now listen close and hear this out. There's a podcast network that covers just about everything that you've been searching. Hey! The Golden State Media Concepts Podcast Network is here. Nothing less than a podcast bliss with endless hours of podcast coverage. From news, sports, music, fashion, cooking, entertainment, fantasy, football, and so much more. So stop lurking around and go straight out to the Golden State Media Concepts Podcast Network. Guaranteed to fill that podcast itch. Whatever it may be. Visit us at www.gsmcpodcast.com. Follow us on Facebook and Twitter, and download us on iTunes, SoundCloud, and Google Play.
Thank you so much for sticking around with us. This is the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I'm your host, Virginia Lucci, and in our last segment, we went over a little bit about what's going on Capitol Hill, and how that relates to the economy. And in this segment and the next, we are going to talk a little bit about Berkshire Hathaway and the Oracle of Omaha, Warren Buffett. So, first thing we're going to do is talk about who. Berkshire Hathaway is an American company that is known for its leadership by Warren Buffett. He's considered as the most successful investor in the country. Buffett serves as the chairman and chief executive of the company, with Charlie Munger as the vice chairman. Berkshire Hathaway, which is amongst the largest publicly traded companies by market capitalization, operates as a holding company within multiple different industries. The company fully owns several firms, such as Geico, Duracell, Dairy Queen, and Long & Foster, while also holding a significant amount of shares of huge companies like American Express, the Coca-Cola Company, Wells Fargo, and Apple. The company trades at a stock market as two share classes. There are Class A shares that are currently priced at around $270,000 per share, and Class B shares, which trade at about $200 per share. Clearly, this is a huge price difference, and there are some fundamental distinctions between these two share classes. First of all, my house isn't worth $270,000, but I live in Alabama, so. What makes Berkshire Hathaway so special? So, first, the company didn't go through any stock splits. This is what differentiates the business from other major companies like Microsoft, Apple, or Amazon. And the CEO of the company is considered to be the guru of investments. Warren Buffett isn't willing to have any stock splits for multiple reasons. He doesn't like any short-term traders to think that they can consistently make quick money out of the stock simply because they can. Any stock splits would have eventually brought down the share price to such a low price range where even day traders could trade the stock. A stock split essentially increases the number of shares outstanding while decreasing the cost of each share. But Berkshire's Class A shares have never been split in the history of the company. The stock has risen along with the value of the business, and thus is now the most expensive stock trading on the stock market, worth more than my house. Back in 1996, the company issued Class B shares as a reaction to mutual funds that tried to mirror the performance of the stock, since most retail investors didn't have the ability to invest in the company because of the high price of only existing Class A shares that at that time were priced around $30,000. The new B-class shares would prevent any small indirect owners from making naive investment decisions based on the unfair conditions of unit trusts, which were the only option back then that enabled them to be part of Berkshire's growth. Additionally, the extremely high stock price encourages potential investors to really think about the investment in the long term and not what might happen to the price of stock in the short run. The high price may also play a sign of acknowledgement for investors that have invested in the business a long time ago when the company wasn't as big. While stock splits wouldn't change the value of the underlying business, but would only change the price of the share, they would actually create more opportunities for short-time traders and therefore would it would give them a little bit, the stock would fluctuate a little bit more and would increase the demand. Class B shares have already gone through a stock split back in 2010 by a 50-to-1 split and are now trading at a more normal price range. So wait, why are we talking about Berkshire Hathaway? Why is this relevant today? Okay. Well, the answer to this is that Berkshire Hathaway filed its SEC Form 13F for the second quarter of 2020 on August 14th. And this is where they give us what their holdings are and, gives us a good overview of the company. So the August 14th form indicated a reduced holding of banking and financial stocks while taking a $564 million position in Barrick Gold. The gold purchase really surprised a lot of observers. Berkshire chairman and CEO, the Oracle of Omaha, has really derided investing in gold. The magical metal was no match for the American metal, he used to say. He wrote that back in February of 2019. And that was a really long time ago, with all things considered. So clearly Buffett's changed his mind. He started off cutting its holding of several banks and financial services stocks. He cut Wells Fargo, JP Morgan Chase, PNC Financial Services, where it had just started buying more PNC, M&T Bank Corp, Bank of New York Mellon Company, U.S. Bank Corp, MasterCard, and Goldman Sachs and Visa. And we'll go into a little bit more in depth into this in the next segment. So just stay tuned. Berkshire maintained a $925 million or 925 million share stake in the Bank of America as of the end of the second quarter, and this remains Berkshire's second largest equity position behind Apple Inc. at $89.4 billion. Yet, the Berkshire Hathaway boss just acquired nearly 21 million shares of Barrick Gold, a gold mining company based in Canada, no less, worth $563 million. The move really kicked up buzz among gold bugs and other Wall Street watchers across the internet, who saw Buffett's trade as perhaps signaling a shift in his views on the gold market, which I think is pretty fair to say. The popular Zero Hedge blog took a deep dive into Buffett's repositioning, saying that it's a signal that none other than the Oracle of Omaha appears to now be quietly betting against the United States, because the famously anti-gold investor has abandoned banks, the backbone of America's credit-driven economy, in favor of a gold miner. That really resonates for me, because I think that shows that the liquidity of the American economy is really suffering, and to put money in something that is actually something physical means that the idea of American money is really out the window. Mike Shedlock of Stico Pacific Management remains calm about this news. He explained in a blog post that it's as simple as Buffett knows financials are struggling due to COVID, and Barrick pays a dividend. Well, I think a lot of other companies pay dividends. But he goes on to say that Barrick is merely a tiny piece of the overall pie, and Buffett didn't back off his stakes in Amazon or Apple. But, I think it's 6 of one, half a dozen of the other. I don't think that Amazon and Apple are in the same league as some of the other stocks that we've mentioned. This is neither a huge cave-in nor a fundamental sea of change regarding gold, Shedlock wrote. Potentially, it's a short-term sell signal that corresponds with a recent pullback. Barrick Gold actually rose 8% in after-hours trading on Friday after the announcements. On the same day, gold futures ended lower, pulling back after 2 straight days of gains, with prices registering their first weekly loss in 10 weeks on the back of recent strength in the U.S. Treasury yields. And this was all before Berkshire Hathaway's announcement, or people found out about Buffett's purchase of gold. So last week began with gold trading in record territory, but will end with several factors weighing on the price of gold, including the hopes of the COVID-19 vaccine, a rise in a rise in yields, and higher government yields and government debt have been attributed to somewhat of the softness of gold. So, and gold doesn't offer a yield, but so that's what it is. The cost of carry gold is negative in the current environment, as investors are not sacrificing interest to carry hard assets such as gold. But again, this was all prior to Berkshire's shift. For those that are into cryptocurrency, this shift is really exciting. Max Kaiser, an avid Bitcoin investor who has invested in companies like Kraken and Bitfinex, believes Buffett's gold investment could benefit Bitcoin. He said that the positive sentiment around gold implies a higher valuation for Bitcoin, which some consider as digital gold. Although Bitcoin has outperformed gold since April, the price trend between the two show a lot of correlation. Data from Skew show that the two assets have increased in tandem throughout the past 4 months. The simultaneous rally of Bitcoin and gold since the global market crash in late March hints that more investors are starting to consider Bitcoin as a store of value. Most recently, MicroStrategy, a $1.4 billion intelligence conglomerate, purchased $250 million worth of Bitcoin. The firm said Bitcoin would act as the company's primary treasury asset, acknowledging Bitcoin as a store of value and a potential safe haven asset. But, similar to his views on gold, Berkshire Hathaway CEO and chairman Warren Buffett continues to reaffirm aversion to cryptocurrencies. Back in February, he told Becky Quick on CSNBC in a Squawk Box interview, cryptocurrencies basically have no value and they don't produce anything. In terms of value, zero. He continued that, I don't have any cryptocurrency and I never will. Buffett has been a longtime critic of the world's largest digital coin and probably any other cryptocurrencies and altcoin. He called Bitcoin probably rat poison squared ahead of the 2018 Berkshire Hathaway annual shareholder meeting. A mirage, not a currency, and tulips are among the description Buffett has used for Bitcoin. Berkshire Vice Chairman Charlie Munger has called it a turd and said that trading cryptocurrencies is just dementia. Last year, in an attempt to change Buffett's mind, this is so funny, Justin Sun, founder of cryptocurrency Tron and CEO of file sharing company BitTorrent, bid $4.57 million in a charity auction to have a meal with Buffett. When Justin and 4 friends came, Buffett said, they behaved perfectly, and we had a friendly 3.5-hour dinner, and the whole thing was a very friendly exchange of ideas, Buffett said. But he added that neither he nor Sun changed their stance on Bitcoin. So, if this notorious anti-gold person is snapping up a whole bunch of gold lately, then, it's not a huge jump that he might go into Bitcoin. But I think that the thing that Buffett and probably a lot of other people like about gold is that it's a tangible asset. Bitcoin is still this ethereal kind of, can't put my hands on a Bitcoin. So it remains to be seen. We'll keep an eye on this development, and if there's anything else that comes out of it, I will give you updates. And so with that, I'm going to take another quick break, and when we come back, we will go over the top 10 stocks that Warren Buffett is selling. Stay tuned.
Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand.
All right, welcome back. We've reached the end of the show, and as my long-term listeners know, I like to end every show with a top 10 list. And since we were talking about Warren Buffett and his radically different portfolio, we're going to continue that a little bit and take a closer look. And I'm going to present to you the top 10 stocks Warren Buffett is selling. Not only is the Oracle of Omaha selling off equities, but has made a few other interesting moves as of late. When Buffett starts a new stake in some company or adds to an existing one, investors read into that as a note of confidence. But if he pairs his holding in a stock, it can spark investors to rethink their own investments. The fact that Berkshire Hathaway continued to shed weight even as the market began to rebound in the second quarter underscores how challenging it is to make investing decisions these days. So here's the scorecard for what Warren Buffett was buying and selling during the 3 months that ended in June 30th, 2020, based on the most recent 13F that the company filed on August 14th. And remember, not all Warren Buffett stocks, and I'm making air quotes here that you can't see, are actually his picks. Some are smaller positions that are believed to be handled by lieutenants Ted Wexler and Todd Combs. In our last segment, we talked a little bit about some of the banks and financial holdings that he's since released. So if you feel like this is a little repetitive, I'm giving you a lot more information in this segment. So we're going to start with one of those companies at number 10, U.S. Bancorp. U.S. Bancorp is the nation's 5th largest bank by assets and America's biggest regional bank. It's also one of the oldest Buffett stocks in Berkshire Hathaway portfolio. Buffett initiated his position in the first quarter back in 2016. And unlike with many other Berkshire Bank holdings, Buffett really did little with it during the second quarter. Berkshire trimmed 250,000 shares in the second quarter, representing a mere 0.5% of the overall stake. But it's still a reduction. It's still an example of an overall trend. Buffett typically doesn't talk much about U.S. Bancorp, but it has been a solid pick by comparison to many of his other bank holdings. The lender has consistently generated the highest returns among the top 10 banks, and it has delivered a total return of 84% since March 31st of 2006 versus a 28% gain for the financial sector. So that's pretty notable. At number 9, we've got Liberty Media. Berkshire has managed to find a way to own SiriusXM in multiple ways, with Liberty Media being another Berkshire holding that has had for 4 years, and it holds a large stake. Liberty Media holds a large stake in SiriusXM holdings. But in 2015, the company actually recapitalized, offering, among other things, several tracking stocks that allowed its investors to enjoy the performance of Liberty's SiriusXM investment directly rather than get it piecemeal through Liberty Media itself. So Buffett was actually exposed to SiriusXM before it directly invested in SiriusXM in the fourth quarter of 2016. And over time, he has bought more of the tracking stock, with the overall body of which currently represents Liberty's 70% plus stake in Sirius. But again, Berkshire did a little trimming to this position in the second quarter, sort of. He let go of roughly 250,000 Liberty SiriusXM Group Series A shares. But as we'll see in a little bit, that wasn't his final word on the Liberty SiriusXM Group. SiriusXM itself appears at number 8 on the list. SiriusXM reaches more than 100 million listeners via its core satellite radio business and Pandora, which it acquired in 2018. And it's another stock pick related to John Malone, the chairman of Liberty Media, which owns a massive stake in SiriusXM. It's possible that all of Berkshire's investments in companies that are somehow tied to Malone's truly Byzantine corporate structure could very well be the responsibility of one of Buffett's portfolio managers. Liberty Media was a large position held by Ted Wexler's Peninsula Capital in his pre-Berkshire days. But Berkshire's affinity for this particular Malone-related position has been waning of late. Buffett first bought shares in Sirius during the final quarter of 2016. Berkshire unloaded a 1% portion of its SiriusXM position during the third quarter. The Oracle of Omaha then trimmed his position by another 3.9 million shares, or about 2% of Berkshire's stake in first quarter of 2020. But they really went to town in second quarter, unloading more than 82 million shares. That brings its ownership down from 3% to a little more than 1%. But that still makes Buffett the fourth largest owner of Sirius stock, and well behind Liberty Global's 72% stake. I personally prefer podcasts over Sirius XM radio, but I may be a little prejudiced here. Just saying. At number 7, we have Charter Communications. Charter Communication markets cable TV, internet, telephone, and other services under the Spectrum brand, which is America's second largest cable operator behind Comcast. It greatly expanded its reach in 2016 when it acquired Time Warner Cable and sister company Bright House Network. Buffett entered Charter in the second quarter of 2014, but has seemingly lost that love and feeling for telecom company in recent years. His position has been trimmed down from 9.4 million shares in early 2017 to just 5.2 million shares as of Berkshire's most recent 13F, including a 210,000 share reduction in second quarter of 2020. The move away from Charter meshed with a lousy 2018 for the stock, which lost 15% that year, but he had lousy timing in 2019. Buffett continued to sell his position during the first and second quarters, but Charter shares finished a year within a 70% return. Berkshire Hathaway's current stake still represents a decent-sized 2.5% ownership in Charter and a 1.3% of Berkshire's equity asset. But I'm going to make a disclosure here. Charter and I have not had the greatest history. I've always really struggled with their service, and honestly, I'm just not a fan. But, I don't think that that's what they were going on in making their decision, but who knows? Who knows? At number 6, Warren Buffett took a little bite out of his holding of America's 2 largest payment providers last quarter. First up is Visa at number 6, which operates the world's largest payments network and is well positioned to benefit from the growth of cashless transactions and digital mobile payments. With the pandemic and with the coin shortage, I really rarely have cash in my possession anymore. So I see the benefit of going with cashless option like Visa. Visa was the idea of Lieutenants Todd Combs and Ted Wexler, we don't know. And Buffett really said that he wished Berkshire had bought more. But they initiated their position in Visa during the third quarter of 2011, and it has been a mammoth winner, including dividends. Visa has delivered an annualized return of 30.7% since September 30th of 2011. It's also a dividend growth machine, ramping up its payout by 150% over the past 5 years alone. If I had been as smart as Ted or Todd, I would have bought Visa, Buffett told shareholders at the 2018 annual meeting. Berkshire's 0.5% stake in Visa doesn't even put it among the top 25 investors, though it's a not insignificant 1% or so of Buffett's portfolio. At number 5, we have Visa's twin sister, MasterCard. Warren Buffett gives credit where credit is due. While Berkshire Hathaway does indeed own MasterCard at $326 a share, he has nodded to his portfolio managers, Todd Combs and Ted Wexler, who made the call to buy both MasterCard and rival Visa. I could have bought them as well, and looking back, I probably should have, Buffett said about Visa and MasterCard in 2018, referring to his own interest in American Express. MasterCard, which boasts 926 million cards in use across the world, is one of several payment processors under the Berkshire umbrella. However, after mostly leaving the stock alone since entering a position during the first quarter of 2011, Buffett sold off 300,000 shares, or 7% of the stake, in 2020. Don't take this as a bearish stance on MasterCard. MasterCard has returned some 1,270%, including dividends since March of 2011, several times better than the S&P 500 in that time. Warren Buffett was due for a little profit taking. At number 4, we have Occidental Petroleum. Warren Buffett spent the better part of 2019 building up a stake in Occidental Petroleum, but it appears he finally had enough. Berkshire sold its entirety of Oxy holdings in second quarter. Buffett invested $10 million in the integrated oil and gas company in late 2019 to help finance a $38 billion bid for exploration and product firm Anadarko Petroleum. Berkshire continued to amass a stake over the next year, but apparently Buffett's strategy in the energy sector changed. First, he dumped Berkshire's stake in Phillips 66 in the first quarter of 2020. Then he bought natural gas assets from Diamond Energy for about $10 billion in July, and now he's out of Oxy, making Suncor Energy the lone energy component of Berkshire Hathaway's portfolio. Take that for what it will, but the fact that Occidental was forced to slash its dividend early this year is no doubt a factor. At one point, Berkshire's stake represented 2.1% of Occidental's shares, making it the company's 8th largest stakeholder. But that's all in the past now. At number 3, we have airline stocks in general. If you've been listening to the podcast for the last few weeks, you know that I've been very concerned about the airline industry. Apparently, that's the one thing I have in common with Buffett. Maybe more, I don't know. Just as well reported at the time, Buffett jettisoned all 4 of his airline stocks last spring as the global pandemic caused travel to collapse. I don't know whether 2 or 3 years from now that as many people will fly as many passenger miles that they did last year, Buffett said. And I think there's something to that. I think it's going to be a long time before I'm comfortable on a plane again. Buffett continued that they may and they may not, but the future is much less clear to me. So that's what it is. Collectively, Berkshire sold 175 million shares in the 4 air carriers, Delta, United, American, and Southwest. The stakes were worth a total of around $4 billion at the time. In the case of Delta, he sold off the 71.9 million shares in Berkshire's portfolio in the second quarter. As for the others, United shares sales came to 22.2 million. Southwest Airlines shares were 53.6 million, and American Airlines stake comprised 41.9 million shares. Buffett's original airline investments, made back in 2016, raised some eyebrows given his long-term disdain for the industry as a place where capital goes to die. He's no stranger to changing his opinion, but it looks like he was right the first time. At number 2, we have Restaurant Brands International. Evidently, the best chicken sandwich I've ever had is not enough to keep Restaurant Brands International on top of Berkshire's list. QSR is a fast food powerhouse, and it's not like the restaurant biz is really thriving right now because of the virus. Restaurant Brands International was formed by the 2014 merger of Burger King and Tim Hortons. 3 years later, the company acquired Popeyes Louisiana Chicken. It is now the 4th largest operator of fast food restaurants. So where did Warren Buffett come in? Berkshire Hathaway helped fund Burger King's acquisition of Tim Hortons by purchasing a combination of preferred shares and warrants. In a classic Buffett move, he was able to finagle a 9% yield from the preferred shares. QSR redeemed the preferreds in 2017, adding Berkshire's cash to the pile. The loss of foot traffic to restaurants of all sizes and types make the industry's future not so clear. So it's not surprising that Buffett made his exit, selling 8.4 million shares in QSR last quarter. And number 1 is probably the most surprising to me. It's Goldman Sachs. Berkshire Hathaway had been hacking away its Goldman Sachs stake for a couple quarters before unloading everything it had left. The holding company sold the last of its 1.9 million shares in the second quarter. Berkshire first picked up its stake in Goldman during the 2008 financial crisis. Buffett paid $5 billion for preferred shares and warrants to purchase common stock. The preferred shares came with a dividend yield of 10%, almost twice the rate of some preferred stocks, which are already considered generous income pays. Goldman redeemed its preferred shares in 2011. Berkshire bought another $2 billion in GS stock when it exercised warrants in 2013. Buffett parlayed the original investment into what at one point was a $3.8 billion 5.1% stake in Wall Street's preeminent investment bank that made Berkshire its 4th largest shareholder. But times changed, and Buffett is now out of Goldman Sachs business. So those are the top 10, but, I can't just leave it at that. I got to give you one bonus. And Store Capital is where it's at. Buffett is really into the stock. Berkshire's position in Store Capital, which it entered during the summer of 2017, was an unusual one. Real estate investment trusts, REITs, are a way to invest in real estate without really owning the actual assets. And Buffett's really never been really big into them. Store invests in single-tenant properties, including chain restaurants, supermarkets, drugstores, and other retail service and distribution facilities. That's to say, a store is a bet on brick-and-mortar retail, which is thought to be in permanent decline. Buffett spied value, and he spied it for quite some time. Store Capital CEO Christopher Volk told CNBC that Buffett studied the REIT for 3 years before taking his position. The Oracle of Omaha must have seen similar value rise in the company's February to March dip, which sent store shares off by roughly 65% from peak to throat. Because he bought 5.8 million shares, or an additional 31%, to bring his stake to 24.4 million shares, yielding 5.5% at current prices. Berkshire now owns 10% of the shares outstanding, making it Store Capital's second largest shareholder after Vanguard and BlackRock. I've had some requests to do a segment on REITs, so look for that in upcoming episodes. And with that, we've come to the end of our program. Thank you so much for listening, and I hope it's made you smarter. If you could subscribe to the podcast and leave us a 5-star review, I would appreciate that because that really helps us. And if you'd like, find me on Twitter at GSMC Financial News Podcast and let me know what you think of the show. It would be very nice to engage with some of you lovely dear listeners. So with that, I'm going to end this episode, and so hope you learned something, and wash your hands often, wear your mask, and stay healthy. See ya.
You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.